Okay, let's dive into something really pretty extraordinary today.
Yeah.
Imagine this world, right? Wall Street.
Yeah.
It's dominated by, the seasoned pros, the finance types.
Sure, the usual suspects, company reports, economic forecasts.
Exactly. Glued to the news ticker. Now, picture someone walking in from, well, a totally different universe.
Okay.
Not finance, not business school. Pure mathematics, like the really abstract stuff.
Ah, okay. I see where you're going.
And this person, they don't care about gut feelings, market chatter, none of that.
Yeah.
They see the whole financial landscape as just data.
Just numbers.
Vast, complex data sets,
Mhm.
full of hidden patterns, signals, things you could unlock with equations.
Right, seeing it like a scientist would.
And then they build a system, fully automated, based only on this math view. And it just quietly starts making money. Like unbelievable amounts of money, outperforming Wall Street year after year, almost invisibly.
You're talking about Jim Simons, Renaissance technologies.
That's the one.
Yeah.
And we're going to unpack how he did it based on the material you shared.
Yeah, and what's so fascinating really jumps out from the sources is how much of an outsider he was.
Totally.
It wasn't just that he was different from the typical trader, he was almost the opposite.
The antithesis, yeah.
Right. A quiet genius, the sources say. A code breaker back in the Cold War, focused on these really abstract problems. He brought that super rigorous scientific way of thinking, data, proof, logical systems.
Straight into the messy world of markets.
Exactly, the messy emotional world of finance.
And the results, you just have to look at the numbers first, right? They're staggering. It sets the stage for why we need to look at this approach.
Absolutely.
His main fund, the Medallion Fund,
Mhm.
we're talking over $100 billion
Yeah.
in profits, just between 88 and 2018.
100 billion. It's almost hard to comprehend that number.
It really is. And the returns.
Oh, the returns are just astronomical. Average annual returns before fees were something like 66%.
66%.
Average. Average.
Yeah.
And even after they charge these incredibly high fees, I think the source mentioned 5% management fee and like 44% of the profits.
Which is huge in itself.
Huge. The average annual return after all that was still 39%. Over 30 years.
30 years. That kind of consistency.
Our source calls it unmatched. And I think that's probably accurate.
Yeah, unmatched feels like an understatement, doesn't it? It wasn't just a hot streak. It was decades of crushing the market.
Right.
And like our source points out, this deep dive, it isn't really about trying to figure out his specific stock picks or timing the market in the old school way.
No, not at all.
It's about the system, the machine he built,
Mhm.
and the unconventional people he brought in. And that fundamental mindset. How did a mathematician do this?
Exactly. That's our mission today, really, to get into the core principles behind that success. Not just the billions, but the thinking behind it, the systems, the processes.
How could someone from so far outside finance see the market so differently and build something Wall Street just hadn't?
It challenges everything, really, about what it takes to win in that world.
It really does. What can we learn from this? Not just for investing, but for building any kind of system for success. So let's start there. That fundamental difference in how he saw things. Seeing the market as an equation.
Yeah, that's absolutely the foundation. The core idea in the source material is just that. Simons looked at the market like a scientist looks at any complex system.
Not like an investor chasing headline.
Right. Most people are looking for the story, the narrative, reading the news, listening to earnings calls, following gurus, reacting.
But Simons and his team were asking different questions.
Totally different. They were asking, what does the data say? Quantitatively, can we model this pattern mathematically?
And his background just screams that approach, doesn't it? He was an MBA, PhD in math from Berkeley at 23.
23. And his specialty was differential geometry, super abstract math.
Yeah.
And the source mentions he even co-developed something called the Chern-Simons theory, which is apparently used in quantum physics now.
Wow. Okay, so we're talking serious theoretical horsepower here.
Absolutely. This is the kind of mind trained to find deep structure in really complex, abstract stuff. So when he turned to markets in the late 70s,
He brought that same lens.
he brought that fundamental belief, as the source puts it, that everything, even the chaos of the financial world, could be modeled.
That's a huge leap, though, isn't it?
Yeah.
To look at the craziness of stock prices going up and down and believe there are, findable patterns underneath it all. using math.
It is a massive leap, and it totally dictated how they approached it, where most people saw noise, random fluctuations driven by news or fear or whatever.
He saw signals.
Signals buried in the randomness. He wasn't interested in the story of IBM or Ford. He just wanted to find these tiny, overlooked, repeating patterns in the price data itself.
That famous quote really sums it up.
Yeah, I don't want to know what a company does. I just want to know what the data says.
That's so blunt, just cuts through everything else. It's pure empiricism.
Pure data. And Renaissance Technologies was built on that belief, that if you had enough clean data and the right math models, you could find these. What does the source call them? Edges invisible to the human eye.
Okay, what exactly is an invisible edge? Is it like a secret code?
Not quite a secret code. Think more like really small temporary glitches in pricing, or tiny statistical biases that aren't obvious if you're just watching a screen.
Like a stock price being slightly off for a few seconds.
Maybe. Or a pattern that repeats just a tiny bit more often than random chance suggests. Or a small mismatch between related assets. To a human, it just looks like noise, like random jitter.
But to a powerful computer model.
Analyzing millions of data points at once, it might reveal a tiny exploitable statistical advantage. Very fleeting, but real.
So it wasn't about predicting the next big thing. It was about measuring the market incredibly precisely.
Exactly. The source nails this contrast.
Yeah.
Simons was measuring the market with equations. Almost everyone else was trying to outguess it with stories.
Seeing structure versus just randomness.
And this mathematical view wasn't just a theory. It meant they had to build automated systems.
Right, because humans couldn't do it.
No way! You need computers to spot these patterns across thousands of stocks, globally, instantly, and then act on them in milliseconds, way faster than any person could react.
Which leads to another crucial point, trusting the math completely.
Utterly. If the model spits out buy, you buy. If it says sell, you sell. Period. No second guessing, no, I don't know, the market feels weird today.
None of that gut feeling stuff.
Zero gut feeling. Because, as the source rightly points out, the human brain is wired for emotion. Fear, greed, hope, panic.
And markets punish emotion. We all know that.
They absolutely do. Emotional decisions mess everything up. You chase stocks up, panic sell at the bottom, get paralyzed. By taking humans out of the loop, Simons built a system that didn't get tired, didn't get greedy, didn't panic. It just executed the logic 24/7.
But it wasn't like he just built the models and walked away, right?
Oh, definitely not. The source is clear on this. He built an entire organization, a whole team, whose only job was to make the models better, continuously, relentlessly. Feed in more data, refine the algorithms year after year.
Always improving.
It had to be. The market changes. So the key takeaway here for you, the listener, it's just so powerful. His amazing performance wasn't just about being smarter in the usual finance way.
It was thinking differently.
Totally. Thinking differently about the whole problem. He asked, is the market just a giant math puzzle? And the answer, for him, was yes.
It makes you think, doesn't it? Where are we relying on stories, on gut feel, when maybe a more rigorous data-first approach, an equations versus stories mindset, might show us something new?
Exactly. Okay, so let's dig into the culture he fostered. The source calls it a deep research culture. And the core idea, belief only in data and testing. Relentless, brutal testing.
No room for hunches?
None. Gut feelings, conventional wisdom. If you couldn't back it up with hard statistical proof from the data, it was irrelevant.
It sounds like a university science lab, but aimed at the stock market.
That's a great way to put it. The source describes this incredibly tough process. Every single idea, every potential pattern had to go through this intense research, modeling, backtesting gauntlet.
Like a trial by fire.
Absolutely. If an idea didn't survive the testing, statistically speaking, it was dead. Didn't matter how clever it seemed.
And the data they used. It wasn't just stock prices, right?
Oh no, it was way beyond that. Stocks, commodities, futures, currencies, sure. But the source mentions things like historical weather data.
Weather? Really?
Yeah, global shipping patterns. Even, and this is my favorite detail from the source, satellite images of Walmart parking lots.
Parking lots? Why? What could that possibly tell you?
Well, the thinking was these tiny predictive signals can hide anywhere. If you can process enough weird data, maybe how full the parking lots are gives you a tiny, tiny edge on predicting sales figures before they're officially announced.
Wow, okay. That's thinking outside the box.
Way outside. It's about finding non-obvious correlations hidden in mountains of data.
So they gather all this crazy data. But the real magic, the source says, was the testing. How intense was that?
Exhaustive doesn't even cover it. They'd backtest a strategy against decades of historical data, not just a few years.
See how it would have done in the '87 crash or the dot-com bubble?
Exactly. They'd simulate thousands of scenarios, stress test it under extreme conditions, see how it performed in bull markets, bear markets, high volatility, low volatility, everything.
So it wasn't good enough if it just worked well on recent data, because that could just be luck.
Right? Crucially, no. The source really hammers this point. Just fitting the past data wasn't enough. That's a trap called curve fitting.
Where the model perfectly explains the past, but has no power to predict the future.
Right. The model had to make statistical sense. It had to be robust across all kinds of history. And critically, there had to be, and I'm quoting the source inspired by Simons here, reason to believe it will persist.
Okay, that's key. Not just correlation, but some underlying logic or statistical property you think will continue.
Exactly. It avoids just finding random flukes in the data, and this rigor was the absolute core of the Renaissance culture.
Unlike other places where maybe a star manager's gut feeling counts for something.
Right. Or where they might tweak a model endlessly just to make the historical results look good, even if it's statistically shaky. At Rentech, if it wasn't robustly proven by the data and testing, it was out, period.
And this must have required checking egos at the door.
Totally. Imagine you're a brilliant PhD, you have this pet theory, and the testing just blows it up.
You can't take it personally.
No. The source says the researchers, mostly these scientists, remember they were on a collective search for truth in the data. They weren't trying to be proven right individually. Being wrong was fine if the data taught you something.
And even the failures weren't wasted.
No, they became fuel, raw material for the next idea, the next model. There's that quote from a researcher the source mentions.
It's like working in a math lab, but the lab is the market.
Yeah, perfect description. Pure science applied to finance.
And the lesson there, it goes way beyond investing, doesn't it?
Absolutely. High performance in almost anything.
Yeah.
It doesn't usually come from just luck or intuition. It comes from building a solid process, testing it constantly, finding the flaws, fixing them, repeating.
Discipline in the process,
Right.
not just hoping for the outcome.
Exactly. The source has that killer quote to wrap it up. If it's not tested, it's just a story, and stories don't beat the market. Systems do.
Wow. Powerful reminder. Okay, let's shift to the team he built. The source calls them the Misfit team.
Yeah, and for good reason.
Huh.
The core idea here is just wild. Simons deliberately hired scientists, math PhDs, physics PhDs, computer scientists, linguists, cryptographers.
But not finance people.
Exactly. People who had never worked on Wall Street, never traded a stock in their life, probably.
That sounds insane. Why hire people with zero experience for one of the most cutthroat industries there is?
Well, Simon's logic, according to the source, was pretty radical. He wasn't trying to build a slightly better Wall Street firm. He wanted to fundamentally outthink Wall Street.
So he needed different thinkers.
Totally different. Minds that weren't shaped by the usual finance habits, the biases, the way everyone else was taught to think. He has that great quote.
Which one?
We hired smart people who had never worked on Wall Street. We taught them about the market, but we never taught them how to think like traders.
Oh,
Yeah.
okay. He wanted their raw brain power and their scientific perspective, not their preconceived finance notions.
Exactly. He wanted the way they approach problems. The source gives amazing examples like Leonard Baum.
The algorithm guy.
Yeah, co-creator of the Baum-Welch algorithm, super important in like AI, speech recognition, bioinformatics. These are foundational techniques.
And he brought that brain to finance.
And James Axe, a world-famous pure mathematician, comes to Renaissance, starts writing crucial code for their trading systems.
It's just mind-boggling. These brilliant theoretical minds tackling stock prices.
Then you picture them, right. The source paints this picture, working in an old strip mall on Long Island.
Not exactly Wall Street glamour.
Not at all. Just running simulations, scribbling equations on whiteboards, writing code. Nothing like the usual image of finance. It must have looked so weird from the outside.
But Simons believed that was the edge, that diversity of scientific thought.
Yeah, his bet was that blending these different scientific viewpoints would find things that a team of only finance people, all trained the same way, would just miss. Conformity breeds average results,
You
right?
need that cognitive diversity for breakthroughs.
Precisely. But just hiring smart misfits wasn't enough. He had to build a culture where they could actually work together.
How did he do that?
The source highlights a few key things. Everyone shared code, openly. No secrets. Improving the models was a team effort. And crucially, Bonuses were team-based.
Not based on your individual P&L.
No, that's huge. It removed the incentive for people to hoard their best ideas. It wasn't about being a star trader. It was about making the whole system smarter.
So it was more like a university research department than a hedge fund trading floor.
Exactly like that. Designed to maximize collaboration, minimize ego and internal politics. Just focus on the intellectual challenge together.
And that collaboration became a competitive advantage in itself.
Massive advantage. Ideas spread instantly. Breakthroughs got integrated system-wide super fast. They could iterate and improve way quicker than firms where information was stuck in silos.
Because they weren't competing with each other, only with the market.
That's the key. A unified team versus the market. That kind of culture learns faster, adapts faster. It's just more robust in the long run.
So the big takeaway here, it's not always about having the traditional resume, is it?
Not at all. Deep thinking, diverse perspectives, a culture where ideas beat ego, that can be way more powerful.
Love the quote the source uses here. If everyone thinks like a trader, you'll get trader results. But if you think like a scientist, you just might build something Wall Street never saw coming.
Nails it. Okay, let's talk about the actual doing it, the execution. The source calls this emotionless execution, building a money machine that never sleeps.
Right, this is where the rubber meets the road. The automated system takes over completely.
Completely. The source is emphatic. Every single trade, buy or sell, was dictated solely by the algorithms, running 24/7 across all markets. Deliberately emotionless, as they say.
And that wasn't just for efficiency, it was philosophical.
Foundational. Simons fundamentally believed that letting human feelings, intuition, fear, greed, anywhere near the decision-making process would just kill the edge. Those tiny statistical edges they found, they're fragile.
Easily wiped out by a bad emotional decision.
Exactly. Math, tested rigorously, executed by a machine, is consistent. Human intuition in markets is all over the place, biased. Often wrong when it matters most.
So no analyst waking up thinking, I feel good about tech today.
Zero. The entire operation ran on code, millions of lines of it, embodying all that research, all those models, signals, rules, derived from data proven in backtests.
Because it was automated, it was fast.
Instantaneous. The moment an algorithm detected a pattern, boom, the trade happened. Buy, sell, rebalance, get out. No human hesitation, no second thoughts, no delay from fear or analysis paralysis.
Which is crucial for those super short-term patterns they were trading.
Absolutely. Those edges might only exist for seconds. You need robotic speed and discipline to capture them.
Which reminds me of that Simons quote.
The sleeping one.
Yeah.
Yeah, if the system doesn't work while I'm sleeping, it doesn't work.
That says it all, doesn't it? He wanted a machine, a self-sufficient engine running independently day and night, whether he was watching or not. No human fatigue, no human emotion.
Think about the contrast with typical trading floors. Stress, caffeine, adrenaline, people fighting their own psychology. Simons aimed for the opposite. A calm, logical, automated machine, just executing probabilities.
And this is how they made the billions. Not from home runs, but from
Jingles. Millions and millions of tiny singles. The source says most profits came from exploiting these tiny, fleeting inefficiencies, those little patterns, the small price glitches.
each trade making just a tiny bit.
A fraction of a percent, maybe? But the system did it millions of times a day, across thousands of assets. The sheer volume, compounded. That's where the astronomical returns came from.
It's the power of compounding applied to tiny, high-probability edges executed flawlessly.
Scaled up massively. It wasn't magic, it was industrial scale, emotionless, high-probability trading. The source calls it a thinking machine, a money machine. Never panicked, never got greedy, never tired, just beat the market for decades.
The lesson is pretty stark, isn't it? If you want results that are out of the ordinary, you might need to eliminate ordinary human emotional reactions from your process.
Yeah, the market truly doesn't care how you feel. Letting feelings drive decisions is usually a recipe for getting punished. It really makes you think about where emotion might be creeping into your own processes, right? Investing, business, anything.
Definitely. Okay, fifth section. This one is fascinating because it goes against the grain so much. Scaling with discipline, why Simons chose small over greedy.
Yeah, this is where Simons really broke the mold. The standard playbook in finance if you have a winning strategy.
You scale up fast,
Yeah.
get as much money under management as possible.
Right. Open the floodgates, more assets mean more fees, bigger empire. That's the goal for almost everyone.
But Simons, he did the opposite.
Completely the opposite. In 2005, the source says, despite Medallion having this unbelievable track record, attracting potentially limitless outside money, he shut it down.
Shut it down to new investors.
Closed it completely to outsiders. Turned away billions in potential fees, potential growth.
That seems crazy from a business perspective. Why?
Because his priority, according to the source, wasn't maximizing assets, it was protecting performance. He understood something crucial. More money doesn't always mean more success.
How could more money hurt?
He realized that throwing too much capital at their specific strategies could actually break the system.
Break it. How?
Think about those tiny edges they traded. If you try to make huge bets based on a tiny, fleeting inefficiency, your own giant trades start moving the price against you.
Ah, the market impact. Your own buying pushes the price up too fast, wiping out the edge you saw.
Exactly. It's called slippage. Your strategy's capacity is limited. Too much money trying to squeeze through the same small door just kills the opportunity for everyone.
So by keeping Medallion relatively small, just for employees.
He preserved the effectiveness of their best strategies. He deliberately chose protect performance over chasing scale. Integrity of the system first.
And again, the results speak for themselves. Over $100 billion in profit, insane returns. All done without taking public money, without hype, without ads, just quietly executed.
It's such a powerful lesson in prioritizing better over just more, while everyone else was racing to be the biggest.
He focused on being the best by staying disciplined and relatively small, at least for that core fund. He refined the machine, didn't just try to pump more fuel into it.
Right. The takeaway's huge. Sometimes limiting growth is the smartest way to sustain high performance. Where might bigger is always better be the wrong idea for us.
That quote captures it. To win bigger by thinking smaller. To scale your system, not your ego.
Love that. And the other one, more money doesn't mean smarter money, but smarter systems, those scale forever. It's about optimizing the engine, not just overloading it. Makes you think, where is more the enemy of better for you?
Definitely food for thought. Okay, final section, maybe the most important. Building the system, relentless refinement. How they dealt with failure.
Yeah, this ties it all together. The core concept. Failure wasn't failure, it was just data. Signals to improve the system.
Back to the science mindset.
Absolutely. Simons's view, highlighted in the source, every mistake is a signal, every loss is a lesson, every market move, win or lose, tells you something. It's feedback.
And this is how they got stronger over time, right? Not by avoiding mistakes, but by learning from them better than anyone else.
Exactly. They had a superior process for learning from failure. The source even says some of their best strategies emerged directly from studying past screw-ups or market shocks.
Like that setback in 1989 the source mentions.
Yeah, that was a big one. First time their models really seemed to break down. The market went haywire, didn't follow the patterns, the fund lost money.
Must have been scary.
For most firms, yeah. Panic, firings, questioning everything.
But Renaissance.
They treated it like a science experiment gone wrong. Okay, what happened? Let's study the failure, dive into the code, rerun the tests with the new data, pull apart the assumptions. What did we miss? What changed?
They analyzed the failure itself as data.
Precisely. They didn't just try to patch the old models. They went deep to understand the root cause. Why did the market behave unexpectedly? What new dynamics were at play?
And that led to improvements.
Big improvements. By dissecting why the models failed, they learned more. Built better, more robust models. The source notes the fund recovered quickly and was dominating again by the late 90s. It proved the power of that refinement loop.
So the systems weren't static things. They were constantly evolving.
Living, learning entities, the source calls them. Every trade fed back into the system. Win or lose, it was learning. Was the signal strong enough? Was the execution clean? How do we tweak the model based on this?
And Simons created a culture where that was okay. Experiment, test, fail, learn, no ego.
Yeah, failure wasn't hidden, it was studied. They didn't just learn from failure. The source suggests they learned how to code failure into the next version. Failure became part of the improvement process itself.
That's profound. Accepting that perfection isn't possible, especially in markets.
But progress is. Always. Long-term success isn't about being right all the time. It's about learning and adapting faster than the game changes. Faster than everyone else.
So they didn't just beat the market initially. They kept winning because they outran the rest of the financial world by learning and improving faster.
That's the ultimate edge, maybe. The speed of learning and adaptation. And that's universal. You don't need to be perfect starting out. You just need to get better at fixing things when they break, faster than the challenges evolve.
Love that final quote from the source for this bit. The winners aren't perfect. They're just better at fixing things when they break.
Simple, but so true.
Okay, so wrapping up this deep dive on Jim Simons and Renaissance. It's just an incredible story, not just the billions, but how he did it.
Yeah, thinking like a scientist, hiring like a rebel, executing like an engineer, it's just completely different.
And he proved some really big ideas along the way. That deep research beats shallow opinion, that models beat emotion, that quiet systems beat loud hype, that compounding tiny edges is the real path.
He didn't predict the future. He just built a machine to measure the present better than anyone and act on it. And crucially, he never stopped refining that machine. Humility, discipline, constant learning.
His legacy isn't just the money, it's the process, the system, the culture.
He didn't just play Wall Street's game better. He changed the game entirely, made it work according to his rules, the rules of math, data, and relentless refinement.
So the final thought for you, listening. Simons was obsessed with building systems, using data, refining relentlessly. How could you apply those ideas, not just in finance, but anywhere?
Yeah, where could a more data-driven, less emotional, more systematic approach help you? What system are you trying to build or improve right now? Learning something new, managing a project, your health, a creative pursuit.
Think about which of his core principles really hit home for you. Was it trusting data over gut, the power of brutal testing, hiring diverse minds? Or maybe that idea of failure just being data for the next version?
Just picking one of those principles and really applying it, it could fundamentally change how you approach things, couldn't it? Worth thinking about.